Content is intended to provide accurate information, however, is not intended as financial, tax, or legal advice. Please consult a financial, legal, or tax professional for specific information regarding your individual situation. Opinions expressed and provided are for general informational purposes only and should not be considered a solicitation for the purchase or sale of any security.
Welcome to Game Plan for Retirement with Chris Mcintire. McIntyre Retirement Services, Northwest Ohio's retirement planning resource.
And welcome into the program. This is your game plan for retirement. With us, as always, is Northwestern Ohio's resource for that common sense approach to planning that we all need in this complex financial world we live in. He is president and founder of McIntyre Retirement Services. Chris Mcintire with us, as always. Chris, welcome back in.
Hey, good morning. Good to be with you, Peter. I hope everybody's doing well here.
Absolutely. Well, we hope you are as well. And we know that you have spent a lot of time and resources, Chris, to help savers and investors across Northwestern Ohio get a better handle on their finances, get that plan put together, and work it to achieve their goal. So we appreciate the guidance that you do provide here on the program. Now, Chris, a big part of navigating our financial world that we live in is understanding the investment options that we have available to us. And so today on the program, diving into understanding some of those options, and there's no lack of them. There's plenty out there.
Yeah, and sometimes you and I could probably make the argument there's too many choices out there. There's 8 to 10,000 different types of mutual funds alone. So hopefully today's show, between our back and forth, we can. I don't want to use the word dumb it down, but keep it simple for the folks that are out there. And you might hear Peter and I talk about safe money, and then we'll call it risk money. And risk money, in our terms, generically speaking, here would be you invest in something and you have the possibility of getting less back based off of market performance. So stocks and bonds, basically, there are certificates of deposit that are safe, that might have early withdrawal penalties, but that's voluntary. So we're not, that's why we categorize them as safe.
We categorize them as safe, but yet, Chris, there is some amount of risk, maybe not market risk, maybe not the risk of loss, but there is some amount of risk with virtually every option there is. And there are some out there that categorize some of these options as all bad all the time, or the best thing since sliced bread. And that really is not the truth either, Chris. It's appropriate or inappropriate for a specific goal or situation. And you just have to understand what your goals are and then what tools can help you achieve those goals in that job.
Absolutely. And, I'm, don't want to pat myself on the back here, but obviously, I think our niche in the marketplace is being independent. And, I actually have a PowerPoint presentation when we're meeting with folks from the show or some of our educational classes, and it starts off with nothing is perfect. And then we list out all the different options, kind of like what we're going to go through here today. I do a visual of this, and, it's very enlightening for clients. And, even if you've got a pretty high degree of financial astuteness, or if you consider yourself, look, I don't know much about this, I'm relying on you. And I think, Peter, why don't we start off on the bank side of things here? That's pretty easy to, kind of get into the flow here. And, with banks, obviously we have checking, savings, money markets. We call that our emergency money. I have an emergency fund. You have an emergency fund. And hopefully, the bulk of our listeners have an emergency fund. And, that's what they include when they want to go to sleep at night. Look, I can sleep knowing I can get my hands on 10,000 for some folks. For some folks, it's 100,000, and then all different pieces in between. And, many of the financial pundits here, may say, look, you need 4 to 6 months of your living expenses, in an emergency fund. And, I think that's probably pretty good rule of thumb to have anyway, kind of depending on everybody's situation. But, 3 to 6 months, 4 to 6 months, pretty good place to start. What do you think, Peter?
Yeah, great starting point. And I heard a good definition of emergency account. It's the money that allows you to turn an emergency into an inconvenience. If you've got it there, if it's available, if you can stroke a check and solve a problem, it's an inconvenience. If you don't have it, then it's an emergency. You have to go into debt, or you can't solve that problem immediately. Then you have an emergency. The emergency account is what actually helps you prevent financial emergencies. And Chris, the bank even though it's low interest, we're not real excited about what we're earning in bank accounts right now. That is the appropriate place to keep your emergency account.
Yeah, absolutely. Call it sleep insurance, if you will. And, I think in the year 2020, maybe 2021 will be different. Most folks probably have more money in cash now than they normally would in a, if we want to call things normal. I'm not sure when we get back there, but, most of us would agree that, with vaccines coming out here, we should be closer to some degree of normalcy, and people may spend some of that savings money and get that working in the economy. So that's another bright spot that's out there to kind of tie those two in together. Savings accounts money might come down, and savings levels may come down, I'm sorry, and bring some of that money back into the economy. On the, sticking with that bank side of things, Peter, banks offer certificates of deposit, or, we make the joke on the show here, certificates of disappointment right now. And, not to understate the importance there, but that's
again, because of the low rates, right?
Correct. Low interest rates there. And, why tie money up for less than 1% for 3 years? I think that's fairly, probably not in everybody's best interest.
Disappointing.
Disappointing. And, it'll get better at some point as the economy recovers and rates begin to recover as well. But it's, that's going to take a little while right now. So, Peter talked about risk at the beginning of the show here, and, everything has risk. A certificate of deposit has a risk. It's not risk of market loss. It's not risk of the bank going out of business, because, most CDs are FDIC insured. Again, I'll say most, not all of them, but most of them, for purposes of our discussion would be. But they have inflation risk. So if inflation is running at 3% and the bank is offering you, less than 1, well, guess how much purchasing power you are guaranteed to lose every year.
Yeah, you've called it losing money safely or lazy money. And Chris, right now, the bank is providing us that haven to lose our money safely. And the safety aspect is there. Like you said, you defined what we mean by safety at the beginning of the program. When you go back to that account, there's not suddenly going to be less there unless you have withdrawn it, taken it out to spend it. But there is less in terms of purchasing power. And I think if people had to write a check for that loss of purchasing power, they might think about that safe money a little differently. And Chris, with the volatility that we've seen in the market, there have been plenty of people who had probably more than is appropriate, more than just that emergency account, sitting at those low interest rates for extended periods of time. And in some cases, years, in some cases, decades or more, because a lot of people got gun shy and moved that money into cash in the Great Recession or even the dot-com bubble. And in those cases, Chris, that could literally be the difference in several hundreds of thousands of dollars over the course of time.
Yeah, you're exactly right. And I could cite many examples of that same situation there, where emotions got the best of people, and, even the fear of missing out, or FOMO, if you will, did not get them back into the marketplace. And, I'll be honest with you, we've got a number of different clients that have sent emails here now that the presidential election is over, is, all right, when do I get back into the market? And, should have probably never gotten back out of it, to be honest with you. And, I'd be easy on my words here because we're on public airways, but, look at what the market did leading up to the election, through the election, and even all the uncertainty thereafter. And, the market really didn't care about all of that. I think they, forward looking, and are looking at the stimulus packages and, eventual recovery of where we could be going if we get the end of the pandemic here, with shots going in the arm right now, if you will.
Yeah. Well, again, today on the program, talking about understanding your investment options with Chris Mcintire, president and founder of Mcintire Retirement Services. And all of these options, they are part of the planning process. You have to identify what your goals are, and then identify what options are best suited to help you achieve and reach those goals. And that's through an understanding of what these options can provide you. Chris Mcintire can talk that through with you, and as part of that planning process, providing you with your game plan for retirement, that document in your hands that you can refer to, that outlines your goals and a timeline of how to achieve them. I'll also make recommendations on what tools to use in order to help you be efficient and best achieve those goals. Pick up the phone if you'd like to get that game plan for retirement in your hands. No cost, no obligation. You can talk over your goals with Chris, design that plan, and then talk with him about how to implement and execute that plan. Yours with no cost, no obligation, just for being a listener to the program. Pick up the phone now and give a call, 800-868-1194. That's 800-868-1194, 800-868-1194. Chris, kind of moving up the scale here, one notch, still on the conservative side, but bonds or fixed income bond funds have traditionally been the more conservative side of an investment portfolio. Now, this does not mean that these are safe and can avoid or prevent losses, correct?
That is correct. And, I think the average listener today would say, as I get older, should I be repositioning more into bonds and away from stocks to get away from those sudden price movements in stocks? The bond market's certainly different right now with the low interest rates as well, because every company out there is, working to refinance their debt or their bonds at a lower interest rate. So that means that, the buyers of individual bonds or bond mutual funds, are getting future lower rates of return as all these companies refinance their debt. And, we'll talk about a couple of different risks here in the bond market. And as we do this, folks, so think you own one specific bond for the purpose of this conversation right now. So break it down. I own a bond of XYZ government or XYZ corporation. You have default risk or credit risk, we could call that. If the company that you own that debt of goes out of business, you could lose a substantial, if not all of your potential investment there. And that would probably come more on the high yield bond space, the higher risk, not necessarily out of the U.S. government. We have never defaulted on our debt. And, we'll save the argument for how big that hole is getting in the credit card that we're running up. So I'll digress. We have interest rate risk. This is the one we probably want to highlight quite a bit on here on the show, Peter, is, if I buy a bond right now and it's paying 2.5% interest, and then 5 years from now, new bonds are coming out at 5% interest, for example, can I sell my bond and get face value out of it? Say $1,000, that's the face value, and take that $1,000 and buy a bond at 5%. Well, the question is, why would a bond buyer want to buy your bond at 2.5 when they could buy one at 5% themselves? So you would have to sell at a loss, or if you looked at your investment statement, you would see those bonds are priced to market value every time you get a statement. And that's sometimes why you have parentheses around bonds, because, they have a market value and a maturity value, and not everyone holds their bond until it matures, where you get your principal back.
Yeah. Some things that we just don't understand or are not explained to us. Not a whole lot of education, honestly, Chris, about all of these different choices and options and what they truly are and what they mean. Bonds, we're told, have been that more conservative side, but there's a handful of risks that even they are exposed to. And we're seeing a number of those right now. The long term that a lot of bonds lock you in for, and then the volatility that can occur in pricing in the meantime, the duration risk, the interest rate risk, the credit or default risk. All of these things are risks with even that more conservative side. So, Chris, a lot of investors are chasing higher returns, especially with the market having done fairly well over the last decade. Stocks are that more aggressive side of the portfolio. And I think something that people have a little bit better grasp on what these are and the role they play in the portfolio. Maybe not.
Sure. And, if we think about the relationship between stocks and bonds, is that bonds have a maturity value where you get your money back. Stocks do not. Traditionally, in a normal interest rate environment, you can make used to be able to make a decent rate of return in bonds, 4 to 7%, without, taking stock market type risk. Okay? And, we're obviously in that low interest rate environment that makes stocks more attractive. And even if a company pays dividends, okay, which is, a version of interest, if you will, taxed a little differently. Interest is taxed as ordinary income. Dividends can be taxed as in the capital gains rate. Okay. So, I'm going to buy Tesla stock, obviously, is an example of a growth stock. They're up 750% or something
Sure.
crazy like that.
Yep.
Every day it changes, and just and so that's an example of an extreme example. Back in March we had a pretty good buying opportunity. March of 2020, that is, you had a great buying opportunity after a big sell-off. The technology sector, working from home and those things
It boomed.
certainly took off.
Yep.
And one could make an argument that, all right, what kind of stock should I be looking at into 2021? And we're not making any recommendations, but you would say, hey, if the vaccines are coming out and the spread gets controlled, all right, that might bode well for the hotels, the cruise ships, the kind of that travel and leisure, the restaurants, companies that are publicly traded, some of the big ones, companies that own like the Olive Garden and so forth.
Well, Chris, a lot of people look at the news and they say, okay, well, the Dow or the S&P, those are the indexes that are advertised. So if I own stocks, I should have those returns. When you just gave a few examples there, Tesla by far and away outperformed the market index, whereas some of the hotels and cruise lines were very much below and lost value, while the market indices were up in 2020. So the market index are a little bit different than the stocks themselves, and people need to understand that. You can't necessarily buy an index, but you can buy index funds, and those allow you to trace the performance of a given index, whether it be the Dow or the S&P or the NASDAQ or many others around the world.
Yes. And, it's a very common way for people to invest. We build portfolios for retirement plans, around indexes, bond indexes, stock indexes. And then we add like satellite positions, if you will. So, looking for some areas where we feel we're going to get some better than average growth, but we don't put all our eggs in one basket. We've got a core portfolio, and we're not here today saying stocks are good or bad, bonds are good or bad. Just talking about the different options that are out there, and not every stock pays dividends. Again, that's the difference between a kind of a growth stock and an income stock from a classification.
When I own a stock, I am the owner of that company. I own a small portion part of that company. And I hope for two things. I hope that the value of the company itself, the share price, goes up over time. But as an owner, I also expect some of the profits. The dividend is the distribution of those profits along the way as the value of the actual company, Chris, goes up or down. And dividends are great, but they can't be necessarily counted and relied upon for that retirement income plan.
Yeah, you're absolutely right. Cedar Point's a good example here of a local stock that, stopped paying dividends, and they had, typically been paying a 6 to 7% dividend for years and years. And in the pandemic, they closed the park, had to pull back on some resources, and as did many companies across the energy sector, even some of the, I guess you'd call them the stalwarts,
Old reliable.
Old reliables pulled
Yeah.
back, and some of those we're going to see increasing here as time goes on. Some of the bank stocks are, actually paying a little bit higher dividends and whatnot now, as they have survived the worst of it. So, again, what is your overall objective? If you're looking for income, then dividend stocks would probably be a better fit for you on the stock side versus growth stocks, where you only make money if the price of the security goes up.
But still, Chris, while the potential for reward might be higher with an individual stock, so is the risk that we take if that individual company does not manage itself well. A Sears, a Blockbuster, some classic examples there. There are even some bigger ones with GM or Enron or Tyco, that mismanagement and things that go wrong with that individual company, even though the sector of the economy that they were in still did very well. That's the risk that you take with an individual stock. And so you mentioned it for your clients. You're putting together these diversified portfolios, a lot of time using index funds or exchange traded funds, or mutual funds. These are ways, Chris, where we can get a little bit more protection because we're not in just one company. We have diversified across many companies. So we've got to understand where those can play a role in our total planning and portfolio as well, correct?
Balancing risk and reward is very important. And, a lot of times what we do, we manage people's assets and their wealth for them. We manage money. And in some cases, clients have a different expectation of what their money should be doing versus reality. Most people that are listening to our radio show today have no idea the relationship with interest rates and bond prices. And like 2018 is a great example. Federal Reserve raises interest rates 4 times throughout the year, and that pushes bond prices of bonds that are already in circulation down. Why? Because new bonds are paying higher rates. And then what happened when they stopped raising the interest rates? Those bond prices leveled back off. Okay? And those of you that own mutual funds, when they're raising interest rates, the current bonds you have are going to price down. Okay, but the new ones you're buying are buying higher interest rates. So you're buying future higher rates of return. The longer interest rates stay low, you're buying future lower rates of return.
Well, Chris, we've got to understand these options, where they play a role. And again, it sounds complicated, and to many people it is, but that's why having that relationship with a qualified, experienced professional can be so beneficial, whether we are very hands-on or whether we want to leave this job to somebody else. I think having that guidance and that perspective from a qualified professional can be very beneficial in formulating the plan, in implementing and executing the plan, and understanding where we can identify opportunities. And that's what getting that document, Your Game Plan for Retirement, is all about, ladies and gentlemen. Chris Mcintire, his team there at Mcintire Retirement Services, willing to meet with you, put that plan together. It starts with a conversation. Really, it starts with just a simple phone call. And if you'd like to improve your outlook for your financial future, I encourage you to make that call. 800-868-1194 is the number. 800-868-1194. Chris will put together your game plan for retirement, a snapshot of where you are now, a discussion of and written down defined goals for your future, and then a timeline in easy to understand language, executable action items of what you need to be doing in order to make those goals reality, in order to achieve your goals. If you'd like your game plan for retirement, there is no cost, no obligation. Just start with that phone call. Give Chris Mcintire Retirement Services a call now. 800-868-1194. That's 800-868-1194. 800-868-1194. Or go online, McIntyreRetirementServices.com. Chris, the next one on your list, often maligned. I'll be blunt about it. These are not talked about very often in high regard. I'll say they are talked about very polarized. Sometimes people say they are not appropriate, and other times people make them out to be very appropriate and kind of the best option out there. So give us the balance here. Where and when are annuities appropriate, or at least what do they do for us, or what can they do?
Yeah, Peter, you've summed that up very well there. And there's many different types of them. So, it's like you can't label them good or bad, just like with stocks. You can't label stocks are good, stocks are bad. Some companies are performing better than others. Depends what your objective is. So, if you think of the term annuity, a lot of folks will think about, okay, that's my pension plan. I get a monthly benefit on my pension, and if I pass away, it might cease. And we would call that an immediate annuity. I had a lump sum of money I gave to an insurance company, and they gave me a monthly income for a period of time that we agreed on. And typically not the most popular pieces right now. I couldn't even tell you the last time we did an immediate annuity in our office. Okay. Not at today's interest rates. Why turn over a chunk of change and not get anything in return for it? So that takes us to what we call deferred annuities. Okay, where you're deferring when you want to make withdrawals on it. And sometimes you never do. You're just doing, you're going to pass the money on to children or something like that. And then in that deferred type, there are some that are safe from market risk, which we would call fixed annuities or fixed index annuities. And then those that we have, we'll call them risk and safe from market risk, if you will. I'm probably more in favor of using them on the safe side. I prefer that. The variable annuities typically have some fees and market risk associated with them that I steer away from. Just put a personal disclaimer out there. The fixed annuity would like compete with a certificate of deposit. I'm getting a guaranteed interest rate for a specific period of time, and that, if it's a 5-year fixed annuity, at the end of 5 years, decide what you want to do with it. You don't have to turn it into a lifetime income.
You can actually walk away with a lump sum. You maintain control over your asset and your investment.
Yeah, absolutely. Been using those for 20 years,
Okay.
And then, another version of that has become more popular is the fixed index annuity. I don't necessarily need the earned interest or the fixed rate of interest. I'm going to let the insurance company use that money and buy me some upside potential of a stock market index, for example. So they protect my principal. They're using a little bit of the interest to leverage myself off of some returns off of the S&P 500 or the NASDAQ as a generic example. And I can go up with the value of the S&P 500, typically on a 1-year or 2-year basis. Some of these have different measurements, but typically after 1 year, if you have a gain, it's automatically locked into your account and you start the process over again. So they have an annual lock in and safe from direct market exposure. Worst thing that can happen would be you earn nothing.
Now, Chris, these are the ones that are being talked about as the best thing since sliced bread on some other radio programs and advertisements. They can provide benefits, but they are not a solve-all. They are not a place to put all of your money ever. And they do have some limitations and some drawbacks. To be fair, every one of the options that we have discussed on the program and every option that we won't get time to get to today has some benefits and some disadvantages. There are pros and cons, and we have to just be aware of those and weigh them before we choose to invest our money.
Correct. What is the purpose for this particular pile of money? So if you've got, $500,000 and you want some of it safe, what are the best safe options for that dollars? How much of it do you need to keep liquid? Okay. How much of it can you, let ride for a few years? How much of it in your growth portfolio? And then what is the risk tolerance in selecting, individual stocks or just bonds or, exchange traded funds, mutual funds, real estate, gold, all those different types of avenues.
And we probably won't have time to get to a few of those on today's program, limited by the clock here, but real estate, gold, cryptocurrencies, life insurance, all of these things, Chris, again, you can help somebody get a better grasp on and an understanding of where they are appropriate or inappropriate, how much to expose, how to get into each one of those things. That's part of the planning. But one thing I know you did want to hit on before the end of the program was the tax status of each one of these things. How we mark our dollars to be taxed is going to be an important determining factor on how much we actually get to keep of our money. And right now, more than ever, planning around that tax status is pretty vitally important.
Certainly is, Peter. And most of the folks listening to the show today, most of their money is going to be in tax deferred IRAs or 401ks, where when you pull the money out, you're going to pay tax at ordinary income tax rates. And that's a progressive system. The more money you pull out, the higher tax rate you get into, 10, 12, 22, and those are obviously subject to change based off of, the legislation that passes in Washington, D.C. Okay?
I'm chuckling. Chris, you mean that those making higher income already pay more in taxes?
Well, you're throwing me a softball. I'm not going to even swing at that one today, Peter.
Well, Chris, I know that a lot of people are concerned with the taxation on those accounts, whether they are saving on an ongoing basis and they're planning for their future, or they already have a large amount saved in those tax deferred accounts. There's a lot of discussion right now, a lot of concern about how to be strategic, about how to be efficient, about how to plan to keep as much of that money as possible. These are things that you, Chris, as a tax geek, will say what it is. You help people plan around each and every day. And so on this program, we've discussed a lot of your investment options, but almost if not more important, Chris, is the tax status of how you are choosing to save and invest your money. And Chris Mcintire can help you with that, ladies and gentlemen. He can help put that plan together at Mcintire Retirement Services. They help savers and investors better determine their outcome by defining those goals and then working a plan to make those goals a reality. If you would like your game plan for retirement, that document in your hands, pick up the phone, give Chris Mcintire a call. If you'd like a better handle on understanding your options that you have available to you, on how to identify underperforming assets or overexposure to risk, on minimizing fees, if you'd like to maximize lifetime income, there are tools that specifically can help you do that. Chris Mcintire can help you identify those. Pick up the phone, give a call, 800-868-1194. That's 800-868-1194. 800-868-1194. Right up against the clock. But Chris, always appreciate your guidance, your assistance, your input here on the program.
Hey, it's my pleasure. I hope everybody out there is staying safe these days, and keep your eyes on the prize here. We're coming toward the end here.
We always appreciate Chris's time. He's looking forward to helping and assisting you any way he can. Looking forward to hearing from you if you've got questions. 800-868-1194, 800-868-1194, or online, McIntyreRetirementServices.com. We'll talk to you next time on Your Game Plan for Retirement.
Visit McIntyreRetirementServices.com for many additional valuable resources, including other great episodes of Game Plan for Retirement with Chris Mcintire. Be sure to subscribe.
The content of this radio show is provided for informational purposes only and is not a solicitation or recommendation of any investment strategy. You are encouraged to seek investment, tax, or legal advice from an independent professional advisor. Any investments and/or investment strategies mentioned involve risk, including the possible loss of principal. Advisory services offered through Brookstone Capital Management, a registered investment advisor.
Fiduciary duty extends solely to investment advisory advice and does not extend to other activities such as insurance or broker-dealer services. Advisory clients are charged a quarterly fee for assets under management, while insurance products pay a commission, which may result in a conflict of interest regarding compensation.
Any comments regarding safe and secure investments and guaranteed income streams refer only to fixed insurance products. They do not refer in any way to securities or investment advisory products. Indexed or fixed annuities are not designed for short-term investments and may be subject to caps, restrictions, fees, and surrender charges as described in the annuity contract.